Hey, welcome back all to Getting Started with Options. My name is Mike Fairborn, sitting in for Barb Armstrong. You can expect to see Barb likely next week. Great to be here with all of you today. Folks, today I want to take a look specifically at, the short put verticals. I wanted to discuss short put verticals in detail. There are some interesting indications from the market, which we'll take a look at just briefly here as we take a look at the market in terms of strength. We see some stocks, certainly breaking higher. But folks, what's interesting and what we want to do is really take a look at how the volatility ties in to this today. So volatility in terms of the VIX is actually quite elevated. There are opportunities, all else equal, by looking at short options when volatility is high. So I want to take a look at that with you today. I'm joined in the chat by my good friend Cameron May. Any questions, comments, folks, throw those into the chat. Happy to help address those as well with Cam. Welcome to you, boss, Alaron, Kevin. We've got Sharon, Will, and others. Nice to have you here as well as Dom. Good morning to all of you. Looking forward to our discussion. Should be a fun one. All right, folks, well, let's turn to some disclosures real quick to get the show on the road. Options do carry a high level of risk. They're not suitable for all investors. Now, information here we'll be discussing is for informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing does involve risk, including the loss of principal. Keep that in mind. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An ITM option does have a higher risk of being assigned early. A look at the option Greeks. We'll dive into a few of those today. Particularly, for sure, we'll look at the Delta, as well as Vega and Theta. The paper money software application is for educational purposes only as well. So with that, let's turn over into a look at the markets briefly. There's Apple. We'll take a look at Apple here just momentarily. But pulling up the markets as it stands, a little bit of a dip in some of the markets today. Now, we're not seeing that with some of the securities out there, but you can see, we did see a clear break in the markets going higher. As a matter of fact, if I pull this up and just draw a horizontal line, you're going to see that we did extend through this range around 5,700. We got above this high as well. So we kind of consolidated at that level, broke higher. All else equal, that is a bullish sign, particularly when it is in the direction of the underlying trend. Just drawing in here a few higher lows. Of course, yesterday was, and we came very, very close to it today, being another all-time high. Now, not too unusual to see a little bit of these pullbacks here. The main point is can the market kind of sustain some of these levels? What I've been doing recently, too, which I have found quite helpful, is just looking bigger picture, just more broadly at the sectors. And just a quick sector overview as we go ahead and take a look at the sector grid. Now, with the sector grid, as you can see up top here, we are seeing a couple of different areas that have shown recent strength. We've seen flag patterns occurring in, or images of what could be flag patterns. Here's a look at the materials sector: higher highs, higher lows. Consumer staples, something quite similar. These are both in the direction of the trend. We've seen that. We've seen also trend changes within the technology group. With that as well, a big follow through today on real estate. But lastly, I wanted to show you here too, we've seen healthcare, and each of these have really kind of had an impact on underlying stocks themselves. Now, folks, anytime, it's so easy once you have a big picture perspective of the market. We have the market actually down here, how it does relate to given sectors. By the way, if any of you would like this sector grid, let me know. I'll throw it out to you in the chat so you can have this. It's an easy way just to kind of get a good sense of what's moving here. But these are all indices or indexes or sector indexes within the S&P 500, as you can see up here, the labels up top. Now, with that, what we can do is we can easily drill down. Let's say, for example, we want to say what's moving specifically in materials that is in the S&P 500. This is particularly of interest today as we're looking at short put verticals, neutral to bullish, right, with the trend going higher. So let's do this. Let's show you how we can quickly take a look at what companies are within materials, or whatever the case might be, healthcare, what's been moving. What else do we have moving over here? Well, Financials is breaking higher, and we do know that industrials are as well. So let's just do materials, industrials for now. Very quick, so easy to do. Just to the left, a couple tabs to the left over here, we go to the scan tab. And all we need to do here is look specifically within the S&P 500. And within the S&P 500, oh, let me take out that scan that we've got right there. We're going to intersect that with a given industry. Now, that industry we just mentioned is materials. Now, folks, this is going to give us specifically what we were after, what we just looked at, what companies within materials are moving within the S&P 500. I'm just going to go ahead and select the top one, which is really all the materials. You can see there's a variety in here, and we can certainly look into those specifically, but it's going to be apparent what's really kind of moving within this group. Let's go ahead and click on materials right here. These are all of the companies that come up within that list, and there you go. So you can see right here, there are a grand total of 27 materials companies that made up that chart that we were just looking at, and they're all listed right here. You have today's change, and that could be of interest for sure. But all those other scripts that we've built and all the other classes that you guys are familiar with, those could be plugged in over here as well. I mean, what's been moving for, let's say, for example, the last month? Hey, we're in the scan tab, and this is a great way to kind of organize the data. But what we can do is just say, well, here's one for the last, there's 3 months. This is fine. I'll just show you this. I'm going to pull this over, drag and drop right after our percent change, really giving us a bigger picture perspective of what we've got, how these companies have been performing over the last 3 months. And of course, we do have the capacity here to click on that upper, just the column itself to organize based upon performance. And there you go. Isn't that nice? By the way, folks, anytime you wanted to change these, as we might be seeking out companies that are maybe a little bit more established, of course, they're on the S&P 500. But, if we wanted to look specifically, hey, how have these companies been doing over a 1 month time? All you need to do here is change this. I had a 1 month in there. I have no idea where it's at right now, but I swear I have a 1 month in there. Come in here and just change this data from a 64 period to let's say a 22. That would give you a solid month, as opposed to a 3-month time frame. We're just looking at total market days there with the 64. There you go, 22. It's as simple as that. And that's the only data that's being referenced for that time frame. And now it's loading up a 1 month. Now it still says a 3 month, but you guys just saw me. These are the 1 month performances that might be more relevant to what we just looked at right over here in our charts. This is this is actually a 3-month time frame. Each of these are 3 months, but here you go. So looking over the past 1 month, what's kind of maybe run up and maybe flagged a little bit? Well, maybe some of these companies right in here. Let's just pull one up, for example, STLD, because these can be interesting areas that we can focus in on today, as well as we go into our discussion. STLD right there, Steel Dynamics. Okay, so did the scan show us some details along with our script? It did. As a matter of fact, we were able to drill down from, broadly speaking, the broad markets into a shorter term time frame. There you go. That's kind of what they refer to as a flag with really kind of a strong breeze, as they call it. The flag itself is not kind of going down. It's just kind of like a sideways. And these could be very strong and very, very potentially interesting for a breakout, which we actually broke out earlier today, but we came back down. People might be waiting for earnings, but there you go. So some ways to find strength, and shoot, we can look at this today. I really wanted to look at some of the companies that had higher prices, which is where the short put vertical spread really can be effective, particularly when we're just looking at it relative to short puts. I teach that class on Mondays, and there's a big difference there, actually. So having said that, let's go ahead and move into the key aspect that I wanted to focus in on today, which was really volatility, folks. Now, all else equal, I mean, look at the VIX. It's really significantly higher than it had been previously, and I mean for long stretches of time. This is a 1 year. If I scoot over here and just give us a massive chart, a monthly chart, it's just massive in terms of length of time. You can see that we have spent a fair amount of time just off these bottoms. And look at this period of time, off a bottom, over through here. I mean, it was like an entire year here. We had basically, for all intents and purposes, that's at least a year, if not more, that we really spent hovering in that mid range between 10 and 15. We'll call it 12 and a half. That's a lot less than where we're at right now, and that collectively can help to push prices higher of option prices, right? Many of you know that it's a getting started class. So let's drill into that in much more detail so we have that component down. Because all else equal, if you have higher implied volatility, that could be helpful for just the amount of premium that we could be getting off of each of these strategies. And that's really kind of an emphasis with a higher VIX. And the possibility, well, what do we have less than 30 days away? We have an election time frame. Quick note on that, if I could, real fast here, because it is relevant to where we're at. If we look back at what seasonally speaking election timeframes have done, 2016, 2022, I've outlined this, and I outline this each and every week in my Wednesday class, which is market and sectors. But we do have this kind of volatility, and it's playing in just perfectly. In fact, we tend to have a spike in October, right around the high, right around the midpoint of October, and then we dip to November for each of those last 2 years. It's an election time frame. Why do I bring up November? Well, that's the election time frame, and that's where we've had our rally. I'm just going to lay this out just so you can see this, because this does tie into the VIX, as I'm going to show you here in just a second, okay? So over here is 2020. Zoom in. Where is your time frame here on that VIX? There you go. So see the spike through October, about the mid-high October, then a pullback as people get maybe the election jitters or whatever it might be. We see something very similar, eerily similar to 2016 over here, the last one we had. Can I line this up? Well, it's similar, but it's not exactly the same. It looks a lot like this, though. Yeah, we're looking at it. So here's 2016. The prior election period, we looked at 2020, dipped a little, spike towards the mid of October, boom, right towards the end of November there. Keep all that in mind, as when prices go down towards the end of November, I know somebody's going to tell me what happens when the price of the S&P 500 dips, if it does dip. But what generally occurs with the VIX in that scenario? What do you guys think? By the way, AJ, I'm sending it out right now as I'm waiting for a response. Okay, let me get that out to you guys. That was the sector grid. Might save you a little bit of time, getting that set up. Here we go. We'll share that sector grid right there. So here's the link for it. Okay, our scripts aren't guaranteed for accuracy or timeliness, but of course, this is just taking the data that's being fed into the platform already. It's just so you know. Okay, so there you go. I just sent that out, but oh, thank you, XL. Appreciate that. But by the way, guys, gals, what do you see? If markets dip, does anybody know what that is? And this is why I'm spending a little bit additional time on it. If the markets decline, that tends to put pressure on the VIX to the other direction. We've seen that over the last couple of election cycles, and we can be kind of anticipating that we might get a spike, and there could be other opportunities that happen towards the end of November. What I didn't show was that although you can go back and take a look at it, seasonally speaking, on both of those election timeframes, we ran towards the end of the year. After we bottomed in November, it was a really strong breakout or rally to the end of the year. Now, we don't know if that'll happen. Seasonality changes all the time. But on average, those last 2 election years, that's what occurred. Okay. So if we did get a dip here, remember the VIX moves inverse to the market itself. And what could the VIX do? The VIX could actually, it's kind of interesting, it could actually flag higher here. Notice we dipped to the middle of October. We could spike up towards the end based on that seasonal impact. Okay, so right now, we might be just looking at stocks that have a VIX, maybe have an implied volatility level greater than the VIX, because we're looking at implied volatility on the S&P 500 right now. So let's go ahead and just take a look at Apple for now, and we're going to talk about the relationship here and why selling options with a higher volatility is all else equal a benefit as opposed to buying options. Okay, so here is Apple. We are on the put side right over here. And that's a look at our implied volatility. So let's just put that over here so we can see this is a reference, right? That's IV, implied volatility. And this is a look at that implied volatility, folks. Now, is this greater than the VIX? Indeed it is. Indeed it is. We're at to 28. We're looking at the next monthly contract out, kind of the front month, you could say, at this point, the November monthly. That is 28. Okay, 28. So it's higher. Now, what on earth does that mean? Well, it's connected to the Vega option Greek right there. And what the Vega tells us is that for every 1% increase or decrease in the amount of that implied volatility, it's going to impact the option by the amount of the Vega. So I just want to clarify that, make sure we're clear on that. So as you look down here, if we were to get a 10% increase in this front month contract, okay, and maybe we will get a push towards the end of the month. We don't know if it'll be that much. I would doubt it with Apple, but that's if it goes up 10%. Remember, for every 1% increase, the Vega, which is what you see down here, I'm going to pick on this. Let's just pick on that contract right there. We seem to be bouncing back and forth amongst one, but there is the 230 strike. That is the amount of the Vega right there. And how many percent increase are we saying we're going to go up by? 10. So if that's up, that's going to impact this option, really just the option range, generally speaking, by 26 cents for each 1%. If it's 10%, well, we can say about $2.60, right? There is a good, quick way to do this just based on that volatility, folks. But this is what that VIX can do. And that's why it's important to understand that. We've kind of tied it into a seasonal time frame, which I wanted to throw out there because I think it's quite unique right now with the presidential election time frame. It's not too often we see ourselves in a presidential election year and then with less than a month to go before that election occurs. And so there is a distinct seasonal impact there that we wanted to reference, and it could impact that VIX. Okay. So with that, let's do this. I'm going to show you over here. This is kind of a great tool. I mean, it is a great tool under the layout. We have a way to alter that to give us an impact of what we could potentially see. You know, what's the impact of implied volatility and time decay, that which would be the theta in the layout under what's referred to as a theo price or a theoretical pricing model. I'm going to click on that right now. Now, here is your theo price. Here's that breakdown over here on the right. Now you'll notice it allows for a few different adjustments here. There's a stock price adjustment of $2. I'm going to just go ahead and delete that for now. We're not going to say anything. I want to kind of isolate this. We know that with theta is the time decay on each and every day, right? That's theta decay. Now, if I put this over here, I'm just going to go out a week in advance. Here's Tuesday of this month. We'll go out to the 22nd, Tuesday of next. But here, let's just say by some strange impact, implied volatility does go up, and it does go up 10. So as I just mentioned over here, this is a cool way for theta to kind of organize this for us. And actually, as soon as I tab through that, it will automatically calculate that theta column. And do you see it over here? It did that calculation. So the theo price calculation. It also impacted theta. But we looked at Vega going up about 0.26, or 26 cents for every 1% increase over here. Shooting it up 10, it did make that impact that we were kind of referencing. Now, it's a little bit lower than we thought because there is the impact of theta as well. But I just want to let you know, it's an awesome tool that you have right at your fingertips. I mean, it's just literally right there. Oh. I got to get used to this different mouse pad, but it's right there in that theo price column. And to get there, let's do this here. To get there, what you want to do is you want to click on this layout. Okay, but what a great way to give you a sense of what the theoretical pricing can happen over different conditions. Now, as I mentioned to you, I've got my own, by the way. I set this up where I do look at these in particular. I've got the Vega in there. Just kind of a standard. By the way, you can set these up. It's really great to do. Just customize your own. These are the ones that I frequently will use. Delta, theta, volume, open interest, and Vega. More on Delta in just a moment, but you can see the impact. What is the impact over the next 7 days? Because theta decays over a 7-day time frame. Well, that was actually it's actually pretty hefty, right? It's a dime every single day for the next 7 days. So we're looking at about 70 cents according to what we're seeing right now on theta, if we were to extrapolate that out in time. So that was a reduction as to the price of the option as well. Okay. So any questions on that? I wanted to make sure we're clear on the Vega, the theta, and of course, really tapping into that cool feature, the Theo price as well. Might be okay with that. Okay. By the way, hello to you joining us as well, Krishna and Sim. Great to have you here, and others, George. Hey, no problem, Dragon Rider. Great to have you here. Let's see. Over here, in the open interest, how's the open interest looking? It's looking very good. I mean, these are 5 figures here. Now, obviously, the more open interest you have, what you're going to get with that is just all else equal, it's just more interest in that underlying option. You're going to get a tighter spread between the bid and the ask price. That can be extremely helpful anytime you want to get in and get out. If the spread's too wide, it's almost like a built-in loss when you try to close it, right? Because the spread's so wide. But this is, I mean, this is a $234 stock, and it's a dime spread. Sometimes traders might try to get, let's say, the 470 on the bid if they were selling that put, for example, as well, because it's heavily traded. Look up top with the volume as well. 33 million already today. Okay, plenty of time left in the market day. 33 million shares. I mean, it is a breakout today. Well, shares broke out. We'll see if it holds the breakout, but it broke out earlier today. Okay. So we're going to zoom back into Apple. Now that we've got a few things that we've looked at, kind of discussed here, some traders might look at it this way and say, well, Mike, you know what? And I chatted about this stock yesterday as an ascending triangle formation, and will it break out above the top, which we hadn't done yet. It's coming on a kind of a rough day. I mean, it's not getting any assistance from the market, right? There's the NQs right there. But it's within the NASDAQ, clear that. It's in the S&P 500 as well, but we're seeing a pushback there towards resistance, but all else equal, it did take out this ascending triangle. An ascending triangle, as you can see in these orange lines, is a price pattern that traders will look at because it's got bullish characteristics, particularly in the direction of the trend, if the trend is already up. And you can see it over here. It's really noted for making higher lows and similar highs. And it just gets into a tighter and tighter range. This is referred to, I'll just put it V here for now, but it's the vertex of the triangle. It's an ascending triangle, and prices will generally break out one way or the other above the sloping line to the upside or below before we reach the vertex, because we're getting tighter and tighter. It's getting closer and closer to that time frame. Boom, we broke out, right? We got above there. We'll see if we hold it, but that could be interesting. And it kind of happened early. So some traders might be saying, well, gosh, I kind of missed the move. I don't know if I really want to buy here. Well, we know that implied volatility is high. It's higher in this stock than it is the VIX. And we know there's liquidity. So what some traders might try to do is just sell a put option at this level and buy another one down here as well to create that short put. So in other words, they might be selling a put here to try to collect or bring in income, buying another one down here. I'm going to talk about this in more detail, but what would that look like? What could we do? And basically what traders are looking for are just prices to hold above whatever short strike we've selected here. So if the price of the stock can hold above here, it's just, likely, more likely that they just, that the option will expire worthless and they can collect that income. And that's really kind of the idea with the short put vertical. Maybe they don't want to necessarily participate in the stock going higher. They might think, gosh, you know what, there's resistance up here. Owning stock might be a little bit riskier. What I'd prefer to do is give it a little bit of sort of a leeway or a buffer zone where prices can kind of go sideways. They can go up as much as they want sideways. They can even go down a little bit, and maybe we can still collect our max gain on this short put vertical spread. Okay, so let's take a look at that right now, and let's talk about delta, the delta option as we do that. Now, delta measures basically, for every 1%, $1 increase in the underlying stock, the option will move up basically by the amount of the delta or down. So you can see over here on the call side, the deltas are positive. On the put side, they are negative. $1 increase on the underlying stock itself, that's going to push the value down, obviously, and that's what happens. And so if stocks go higher, that could influence these positively, right? So because if prices were to go up, we can see that the delta tells us right there what's going to happen with the put for every $1 increase. Well, that option's going to drop in price. That's what puts do, because they're inversely correlated, right? They're different from calls, which are directly correlated with the price of the stock. If the stock goes up, though, on a put, the put will go down. The put will go down in value. Now, of course, you have the theta in there as well, but just to kind of walk through this very slowly and carefully, that's what we're looking at. So if the price of the stock can hold above one of those strike prices by expiration, you've got theta on your side. If it runs up, you've got really kind of the delta move in your favor as well, but it could simply just go sideways here, right? And that could be, like I said, for a person that doesn't want to necessarily participate owning stock, which could be expensive. Now, if we look at delta over here, and oftentimes those deltas are selected between a 0.2 and a 0.4. Well, what does this look like on the chart? What does this 225 look like, by the way? So 225, we kind of actually pointed to it previously. It's kind of right in the middle of that range. And sometimes traders will say, hey, is there, gosh, I really can't draw straight on this one. That's funny. Right through there. I'm actually presenting in our studio right now, so it's a little different than what I'm used to. But here you go. Here's your 225, right through there. So right in that range, there's a little bit of support there. Okay, the delta sort of gives us, well, it gives us a bit of an estimate too, in terms of an expectation, like, hey, 27% expectation that it might not go below that level by expiration. And some traders might look at that as well. But we're combining also like support levels too, where prices might hold up as well. Because the whole idea here is, where might we be willing to sell that put at, where we think the price of the stock will hold above out through expiration. And keep in mind, there's an earnings number right there. So what are you guys thinking? Are you thinking the 225? Or do you want to go a little bit lower on the delta and choose maybe the 220, which was very close to the 0.2 delta? The 220 gives it a little bit more range. Sometimes you can go a little bit lower when the implied volatility is higher and still collect a premium. So that's kind of the difference right there that you might see. I'll go ahead and just select the 27 for now. There is an earnings, and so some traders might want to go ahead and just say, you know what, I'm going to stick with the 220, but there's the 225. Let's just go the 225 for now. I'm going to select just the short put itself first, just to kind of show you what that would be. So if prices were to hold above that 225 by expiration, well, we'd be looking to collect roughly $325, right, with a single contract here at expiration. If it holds above there, there's no assignments that occur. I'm going to go ahead and just click on confirm one time and take a look at this. So what is the margin requirement? First of all, margin requirement's really quite high. A little over $6,000 to put that one contract in. Okay, that's the credit less any commissions, and there's your max loss right there. So if Apple were to go to zero, well, that would be the max loss on that trade right there, about 22,000 you're looking at, right? Less the credit. Well, that's the amount, but it's if the stock were to go to zero, that's what you're looking at right there. It's about 22,000. Okay, so with that, as we look at it, it can be very expensive just to do the short put itself. Now, by the way, why is that so high? Well, because if the price of the stock does go below the strike price by expiration, the strike price we could see right up here in our dialog box, 225, then there's a very high likelihood of an assignment, meaning that we have to, for every one, put contract that we sell, for every one put contract here, we have to purchase 100 shares of stock. Is really the very high likely outcome of a scenario like that. 100 shares of stock. So that's why, if we didn't do anything, we didn't touch it, and Apple went to zero, well, that's why you're getting such a big max loss there. What's nice though is just by buying the call right below it. I'm going to hold the control button on the keyboard. So we're going to buy now the 225 put, excuse me, the 220 put right there. I'm going to hold the control button down on the keyboard and click the left mouse button. Now, it doesn't matter if you're on a Mac or a PC, you still get that same functionality. Okay, and now you can see we've got a credit down here, a 105. It's not nearly the 325 that we were looking at, but let's look at some of the characteristics that how this is different. Wow. So it's no longer 6,000 in terms of a margin requirement. It's just under $400. What a difference. Now, we don't get as big a credit, right? We were looking at what, 320 range? It's basically 320 right now is what it's moved down to. So it was basically 320 we were looking at previously by just selling the put by itself. It's less here, but so too is that max loss. And why is that? Well, because we bought the put. So buying the put has a really positive, a beneficial impact here for the max loss, as well as the buying power effect, clearly, right? Totally different. I think this was in the 22,000 range. That's, of course, if it goes to zero, the stock, but you can see it's substantially less. So if there was a big negative move around earnings where, bam, the stock got plummeted, hit really hard, it plummeted over that time frame, and it drops. Well, what's our max loss? 395. We're looking at the confirmation or the order dialog box right there. 395. Big difference than, let's say, the stock really gets hit hard on Apple and it drops, let's just say $20 or $30. Well, we're likely on the hook for every dollar of that going all the way down, right? On that short put, because we own 100 shares at that 225 that we looked at previously. So huge difference here. And you can see on these higher price stocks, it makes a substantial difference when you're doing a short put vertical as just opposed to just the short put itself. Now, what if some traders were okay with a little bit higher max loss? They were fine with it, or the buying power effect being a little bit higher. Well, what they could do is they could add additional contracts and maybe get closer to that 325 credit that they were getting on the short put itself. What does that look like if we break that down? Let's go back to edit here. Let's put on 3 contracts here. So I'm just going to click that a couple more times. We'll get it 3. And I'm going to go down here and click confirm and send right there. Okay, so there's the confirm and send. Okay, how are we doing? Well, we did get close to our credit. It was about 320 we were looking at before. Now there's more commission here. There's 3 additional contracts we're looking at. So keep that in mind as well. But we're getting close to where we were at. Okay, how does this compare in terms of the margin requirement? Well, it's little over $1,100, almost $1,200. But that's quite a bit less than the 6,000 and change that we talked about, that we looked at just on the short put by itself. These numbers can vary, but that's just kind of a reference right now that we're looking at. That also matches our max loss up top here too. Okay, so these are a couple of different ways to look at this, where you can still try to collect. What have we done here? We've collected close to the same amount of that short put, but folks, we have drastically, and I mean drastically, reduced the buying power effect, and I mean substantially reduced the max loss potential. That's the max loss if somebody were looking to do this. Okay, so we did have those additional. We had to buy an additional option. In this case, three additional contracts right there to get that put where it's at, but a substantial impact there, and on a higher price stock. By the way, you could say it this way: it makes it cost less is one way to say it. It's just in the most basic sense, it just costs less for some traders that might not want to fork out a $6,000 and change or $6,800 change, whatever it was, margin requirement for just selling the put by itself. So right there is a substantial impact. Now, we could too, like we said, if somebody wasn't comfortable with the 225 selling that, they could go ahead and sell a one a little bit lower with a lower delta as well. Like we set those delta ranges for the short strike specifically. A lot of traders, not all of them, there are different reasons to choose different deltas. which would give us different strike prices. But really between the 0.2 and the 0.4 is actually really, really quite common. The 0.2 and the 0.4. So let's go ahead and select that for now. We'll just choose the 225 and the 220. So let's go ahead and set this up. I'm going to click here again. I just left clicked on the bid. I'm going to hold the control button down, click on the 220 on the ask. There it is. There's our credit. I'm going to go ahead and we're going to go ahead and go with 3 right now in this paper trade example. Click on confirm and send. And there we go. So again, just to recap, what are we looking for? We're looking for the price of the stock to hold above that 225 by expiration. There we go. Maybe I finally just figured out how this mouse pad works. All right, 225 right there by expiration. So what can it do? It can go sideways. It can go up. It can go down a little bit. And as long as we hold above that 225, the expectation is it's just more likely that we will not, that those can expire worthless. They got to hold above there. And of course, it's much more likely, of course, if we go below 225, that there could be an assignment if it holds between that range. And so always being mindful of trade management. If the price of the stock does do one of these and it dips and you say, well, gosh, Mike, I've had some good theta decay. There's been some good time decay. The unrealized, I have a small unrealized gain. I might try to close it out before because it's doing something that I didn't think it would do. I thought it would hold above maybe this support level or the one below it. Not there, the one here. And then you could be watching it. And if it goes below there, you could consider, trying to close that trade out or offset that trade. Closing it out. And just keep in mind that one of the key benefits is that spread, and that's one of the reasons why we put it in the first place. Because if we are closing it out, it could just be easier to fill at a much better spread. That could be really risky if that spread's wide at the beginning. But we talked about it talked about that at the get-go, saying that it does have high open interest and really good volume. In fact, it's added 2 million more shares over here. Volume on the stock up top here too. It's added 2 million shares. Okay, since we talked about it last. Now, here we go. Let's see. Any questions? I think Cam's got us all caught up. Folks, if you like this kind of content, definitely consider giving us a subscribe. Bottom right-hand corner of the screen. Easy as heck to do. We've got over 123,000 followers right now. Love to have you on board, get great content from Cam, myself, the other coaches. If you like today's presentation, smash that like button as well. All right, I don't think we have any surveys here today. So let's do this. We got a couple more minutes left. We talked about this earlier as we looked at our sectors and scanning through the different sectors and looking at some of these companies that maybe have been performing within materials, because we had seen at the beginning of our discussion that materials had maybe kind of flagged a little bit, and there may be some potential for some of the materials to actually go higher here. One of the things you can do too, I'm going to just pull the volume over here. I think it's always interesting to do when we're looking at, obviously, options. What companies over here do have, a substantial amount of volume that have also maybe been positioned over the last month to show strength and maybe a continuation of the trend. Well, you've got this column over here. This is we flipped this over to our 1 month, although it says 3, we did that earlier. So 1 month performance. It's taking its time to load up though. But we looked at STLD. Look at the volume, not that great. And the spread might not be that great on STLD either, relative to something like Freeport-McMoRan and FCX. So let's look at both of these right now. And I'll just throw out, some potential paper trade examples that you could be looking at as well for a short put vertical. Because remember, it's bullish to neutral conditions, and we're really looking at an upside to neutral, bullish to neutral kind of move. And so having those price patterns in there, folks, and whatever else you can find. Like, for example, over here, what do we have on STLD? We've got a pretty substantial trend line break. So the trend could be shifting here. You did break above this high. You might be forming a higher low here. Look at the consolidation. Look at the potential for a bull flag pattern. Notice we've incorporated all of this because we're looking for strength. We're looking for bullish to neutral, just like on the Apple trade. We wanted to see if prices could hold above a particular support level or as they're breaking about above an ascending triangle in the direction of the trend, is that maybe more likely through the minds of some technical investors to show more strength? The answer to that is, yeah, it very well could be. I mean, that's what they look for, right? Is strength in those. Let's just finish off with FCX here. You can have a lot of fun actually just going through and looking and seeing what these price patterns are. Okay, here's FCX. Look at this. So a sideways, we saw a little bit of a double bottom here on FCX, folks. What is the direction of the trend here? Longer term trend, I would say we're going higher. This is like, this is up. We see a bounce. This is a higher low, higher low. Short term, we have taken out this high right there. And we've actually kind of flagged. That's a really strong breakout. We flagged earnings are coming up. Be mindful of that. There's a lot of liquidity here. I mean, in terms of what we're going to look at the options here in just a second, but there you go. 5 million shares already, but there's a possibility of a flag pattern with a change in trend. You can see the trend line break. Ooh, actually drew that diagonal line in there. Miracle. All right. But we broke the trend line. So there could be some positive technical indications that traders might pick up on, that they might like to see there as well. Now, on an intermediate term basis, you could say, gosh, that's lower. Yeah, that's lower lows and lower highs. More recently, the short-term trend, though, might be reverting back to the longer-term upward trend, right? Because we just saw here is a higher high. This could be a higher low. Let's just take a look at the options here real quick and see how that volume might be having an influence on some of these with the bid and ask spread. And you can see that right there. Very, very good. I mean, penny wise. Well, I mean, 2-3 cents over here. You can see over here on the open interest, something very similar as well. You're in the 4-figure range. Wow, look at the volume on that today. That is volume today. 4 figures alone. Wow. We might not be the only ones looking at this one, folks. 47 and 48. All right. But I hope you found this informative and useful. We did spend quite a bit of time today really talking about the impact of volatility. We showed you how, to reference the VIX. We talked about seasonally speaking, right? How there's oftentimes a push towards the end of the year, the last two election cycles, push towards the end of November for the market to go lower. And that could push the VIX up higher. And then after that, seasonally speaking, it has been strong. Now, that's seasonally speaking, nothing's ever 100% in the market, but we like to take a look at that. We've tied in the VIX. We talked about Theta. We talked about Delta. Talked about Vega. And of course, tying some of that in with the Theo price today. So hope, folks, you found that informative and useful. Always great to be with you. And yeah, take a look at some of these very interesting sorts of strategies out there. Thanks so much, Cam, for your help. And all of you. And as Cam mentioned, be sure to follow us on X. My handle there, Mike Fairborn CS, and Cam's is Cameron May CS as well. All right, all. Have a great day. See ya.